the predecessor and you know this dialogue since we started the lab, and we hope it continues. Again, sorry about the weather. We had a hailstorm when a lot of us left, so I think a few people will arrive, but it's a good time to start. I don't know if it's a metaphor for what will happen to countries under high interest rates, but you will tell us that. So
thanks a lot, Martin. So it's my great pleasure to welcome you in this auditorium of the Banque de France to host this session of the DebtCon conference. So we are very happy to host those events. So we will start now by a panel discussion, and then after that panel, there will be also a keynote speech by Odile Renaud-Bassot. So I hope that we will have fruitful discussions. Yes, I hope that stormy weather is not what we expect on the debt market, but we will discuss that in the panel. So we had a very distinguished panel. So I will first introduce the panelists. We will have 3 rounds of discussions, so about 20 minutes per round, more or less. And then the remaining of the session will be devoted to the Q&A session. So unless you have a very urgent need to ask a question or raise an issue, I propose that you wait for the Q&A session. And in the armchair of your seats, there are mics that you can use to raise your questions or issues. So the panelists, I will present the main speakers by alphabetic order. So I'll start by Ernest Addison, who is governor of the Central Bank of Ghana. So Ernest was nominated in April 2017. And he worked before as a distinguished economist, looking at various issues, especially related to, obviously, economic development, but also monetary policy. He was also engaged in macroeconomic surveillance of African Development Bank and also the West African Monetary Institute. Ernest has also been recently elected as the chairman of the board of governors of the International Monetary Fund and the World Bank Group, 2020. Okay, and he's also the co-chair of the Financial Stability Board, so regional consultative group for sub-Saharan Africa. The second panelist, sorry, I have to. Is Jose Antonio is here. Well, they are in order, actually. So he's a former Minister of Finance of Mexico, and is now senior advisor at Lazard since 2020, and especially supporting the Sovereign Advisory Group. So now he's kind of rating what he did before, in a way. And he was before, so as I said, Minister of Finance and Public Credit of Mexico, and he held also various positions, so as a CEO and Director General at Petróleos Mexicanos. He was also Director General of the Mexican Institute of Social Security. And he worked also as a senior economist at the World Bank, while also teaching at Stanford at the same time. Ishac Diwan is the research director of the Finance for Development Lab. I think you know him well. And I think you already talked yesterday. And you've been introduced already, so maybe I can, yes, gain some time, but still you're also working on a lot of issues related to economic development, but you also worked before also at the fund, I think, the World Bank, and you also taught in various schools like now École Normale Supérieure, but also Columbia. So that's, and Harvard, sorry, plus Harvard. Elena Duggar. So Elena is currently Chief Credit Officer for the Americas at Moody's. And she's also a managing director in the credit strategy and research team. She also chair the Moody's macroeconomic board, which is also looking at the global macroeconomic forecast, which underpin the ratings of Moody's. She's also an expert on the sovereign defaults, and she also worked at the IMF, so that's probably something that is almost common to the panelists. And last but not least, Martin Guzman, who is currently a professor at Columbia University of Money, Credit and Banking, and also at La Plata, University La Plata in Argentina. He's also the co-president with Joseph Stiglitz of the Initiative for Policy Dialogue at Columbia, and he's also a former Minister of Economy of the Republic of Argentina. So with this, without further ado, so just to introduce myself, so I'm Laurent Clerc. I am Deputy Director General for Statistic Research and International at the bank. I recently joined the bank a month ago to cover Bruno Cabriac. And I was formerly Director for Research and Risk Analysis at the ACPR, which is the supervisory arm of the Banque de France. So I'm very happy to share that panel. So as I said, and I will introduce the panel, so we will have 3 rounds of discussions in that panel. The first round will be devoted to gather the views of the panelists on the current situation with respect to deficit and debt level and dynamics. The second round of discussion, we will touch upon also the interplay with monetary policy and look at the consequences and whether they are complementary or sometimes also could be challenging, both at the global and regional level. And finally, we will touch upon the perspective on debt sustainability, and I will elaborate further. So let's now turn to the first round of discussion. So just to introduce the issue, so we will focus now on the current situation and financial stability concerns. So it's fair to say that after the onset of the COVID pandemic, public debt and deficit have increased by a lot and are still very high. And it's likely that debt level will also remain elevated in the forthcoming years. In addition, the government generally did not necessarily fully phase out the subsidies or tax shield that were put in place to mitigate the impact of energy and commodity price shock. So that's still in place. We are facing also a situation which is very heterogeneous across countries, with a particularly divergent trend for low-income economies. Those countries are the ones which also were perhaps the most impacted by the pandemic, but also for which the financing is the scarcer. So perhaps that raises an additional challenge. And in fact, it will also limit the policy space in order to support both growth and developments. And lastly, the surge in interest rate have also increased the debt service burden for these countries, preventing them to spend on essential services and critical investment. So that's why there are quite a lot of challenges. And despite the fact that inflation is currently slowing down, and that financial condition has eased a bit, there is still the possibility of a disorderly adjustment. So we will now ask the panelists to address the different issues, and I will start to give the floor to Elena, and then we'll move to the other panelists. So Elena, please.
There we go. Okay. Thank you. Thanks for having me, and thank you all for joining the discussion today. So I'll start with, I'll give you kind of an idea of where we are in the credit cycle. And actually, we are in a better place today than where we are last year when we discussed it at DebtCon. So a couple of things have changed, right? The macro outlook has stabilized in general, and financial conditions have improved. And we have seen markets reopen. We have seen markets reopen and issuance really pick up through the first quarter of this year, not only on the investment grade side, but on the high yield side as well, and for emerging markets as well. So a lot of the market worries are a little bit less than what they were a year ago. I'll give you kind of the picture on the global sovereign portfolio through three lenses: where we are in terms of outlooks and rating trends, where we are in terms of debt trends and deficits, and where we are in terms of default rates. So I'll start with the outlook. Our global sovereign outlook for 2024 is stable. And it's somewhat of a difficult stable because debt is stabilizing at higher levels. We're looking at higher interest rates going forward, and social and geopolitical risks are elevated. But nevertheless, it's stable. It's also the regional outlooks for most regions are stable. There are only two regions where we have negative outlooks for the region, and it's Sub-Saharan Africa and the Asia-Pacific region. And the Sub-Saharan Africa negative outlook is driven by the outlook on the region is driven by large debt maturities amid still tighter funding conditions. And then Asia-Pac is driven by weak global demand, deteriorating debt affordability, and also downside risks to China with spillovers to the region. In terms of the individual sovereign ratings, so we rate Moody's rates slightly more than 140 sovereigns globally. 77% of the ratings are on stable outlook. So 77, so almost 80% of the portfolio is on stable outlooks. 10% are on negative outlooks, and 13% on positive outlooks. So the positive outlooks actually are slightly more than the negative right now. Two kind of large debt issuers. We have negative outlook on the US AAA sovereign rating, and we also have a negative outlook on China's A1 sovereign rating. In terms of downgrades and upgrades, we went through 3 years where the downgrades outpaced the upgrades. That has now stabilized. So for 2023, we had almost equal number of upgrades and downgrades. And going into 2024, upgrades actually outpacing the downgrades. So again, the credit cycle has somewhat turned. In terms of debt and deficits, for most of the sovereigns, debt to GDP ratio are stable. They're either stabilizing or gently declining. They are increasing for a view, and I can go into more details on that later. But we are not by any means on a firm downward trajectory, so it's more of a stabilization. Fiscal deficits are narrowing. For about 70% of the countries, fiscal deficits are going to be narrower in 2024. The opposite for debt servicing costs. So debt servicing costs are generally rising for all countries, and you're basically seeing fiscal deficits and maturing debt being refinanced at higher interest rate. So it's a very gradual and slow move up. Because of the longer maturity of debt, it feeds into the debt servicing costs a little bit every year, but it is on an upward trajectory. And advanced economies there benefit from very low starting point, but we are seeing material increase for emerging markets. You're seeing a very large increase for frontier markets. So in terms of default rates, and that's I'll sort of the last angle I'll tackle here. We had another year of record number of sovereign defaults in 2023. We had 6 defaults in 2023. That followed 7 defaults in 2022. And then another 6 in 2020. Normally, we're seeing in the rated portfolio, we're seeing 1 to 2 defaults a year. So 6 and 7 is a very, very large jump. And we've now had, I think over 4 years, we've had almost 20 defaults, which is something that took maybe decade plus years to see before. And we expect still the default rate to remain somewhat elevated going forward for the next couple of years. If we look at the share of ratings in the B3 and lower categories, where the most stressed category of the rating scale, that share is about twice as large as what it was before the pandemic. So there's quite a bit of challenges left. So I'll stop here.
Okay, so now I turn to José. So José is going to speak and to address the issue of whether this time is different or not.
Well, thank you. Thank you for the invitation to come and speak here today. Thank you, Laurent, for moderating the panel, and it's an honor to share the panel with people who have been in this business for a while at a similar place. What I want to talk about is, and I speak a bit in cliches, you know, history does not repeat itself, but in Mexico we'd say that it rhymes. So one has to look at it a bit and see if something rhymes. And I think, you know, what I want to leave you with in this first intervention is that we're looking an awful lot from where at least Mexico stands from, like the late 90s. Let me, you know, the US, and, you know, I won't look at advanced economies, but the US inflation is 3.5, and it was 3.5 in the late 90s for the US. The interest rates were 5 to 6, and surprise, surprise, they're 5 to 6. So today, this means, and there are reasons for this. Somebody wrote, my advisor wrote that, you know, Krugman wrote that it's looking like the 90s. So I won't elaborate too much on that, but I think this poses an interesting problem because, you know, if we, you know, a year ago, I wasn't here, but a year ago, everybody was talking about when the rates were falling. And I have another cliche. Wall Street confuses their wishes with their predictions. You know, they wished the interest rates to go down, but that didn't mean the interest rates were going to go down. And my view is that the interest rates are going to stay where they are, like they did in the 90s. And the US and perhaps, you know, the advanced economies did well. You know, there was prosperity. The phrase irrational exuberance came out in the 90s. So things look good if you looked at the United States especially, but perhaps even Europe. Not so good for emerging markets. You know, there was a long line of large emerging countries that had a problem, that ran into serious problems. It started with, surprise, surprise, with Mexico in 1995. If we were to look at a graph of the Fed's interest rate, they climbed almost as fast as today. And so we know we got caught with our hand in the door and we ran into trouble. And I thought it was just, we were going to be an outlier. But, you know, then even a country like Korea, who never runs into trouble, ran into trouble. Other countries in Asia ran into trouble. Brazil ran into trouble. And the economies don't like to divide. You know, it doesn't really work. Even Argentina ran into trouble in the early 2000s. So that's the part I'm concerned about. Because if we repeat the 90s, the late 90s today, you know, emerging markets are going to have troubles, even if the center, so to speak, even if the US and Europe do well and their economies do well. I think we have to look at that. And if we look at that, things are, you know, I said, well, are we worse? You know, are emerging markets more or less vulnerable? And an interesting fact, you know, came out. You know, the deficits are worse this time around. The deficits in the late 90s for middle-income countries were between 2 and 4. Today they're between 5 and 6. The deficits in advanced economies are also worse. You know, Elena mentioned it. They were 2 to 3. Today they're 5 to 6. So this doesn't look good. for debts. It gets me wondering what could happen. The next thing if you look at, and this was a surprise to me, the external balances are not worse. The current account deficits, again, following the IMF divisions by, advanced, middle, and low, they look about the same. In every country, it's a world in itself, but they look about the same. So it's interesting because, as I said, history does not repeat itself, but the inflation looks the same, the interest rates look the same, the fiscal deficits look worse, the current accounts look the same. The balance of payments look a bit worse, and especially in emerging markets, not for the US and Europe, but for emerging markets. But things are also different. The Middle East looks a lot better than anything, and China is playing a much different role today than it was. So I am not saying we're going to repeat, but I am saying, because I'll finish my intervention like that, because history does not repeat itself, but it rhymes. So I think it's worth looking at the issue like that and see where that takes us. But I would say for emerging markets, one should be careful, because I don't think the interest rates are going to fall anytime in the near future.
Thanks a lot. So now I give the floor to Ishac, who will complete this rather gloomy picture, but on another set of countries. Ishac, the floor is yours.
So you wanted me to focus on
you can already react to what has been said both by Elena and Jose, and elaborate further on other areas if you want.
Yeah, I mean, I think this particular financial stress puts countries in Africa and the oil importers of the Middle East, at least Egypt, Tunisia, maybe Jordan, in a very uncertain situation. You said it's a negative outlook. Maturities are high. They are in a gray zone, neither here nor there, in the sense that there were many years of heavy borrowing, but in many countries, good growth. So external debt ratios are not very high, 25-30%, with variations, of course. Ghana, Zambia were higher, but the debt service is very high. Most countries above 15%, and markets are closed, and so refinancing maturities are is very painful. And so the question is, and we've debated that already yesterday, are they illiquid or insolvent? They look illiquid and solvent according to ratios. Now, of course, if you can't refinance anything, or it's at very high rates, you may be tempted to default, or you borrow at very high rates, and your debt will grow faster than your growth rate, and you will become insolvent at some point. So it's very uncertain, and there are two sets of tensions. There are domestic tensions, BOP pressures, devaluations, fiscal pressure, high domestic service, you have high debt service, so you have to cut on expenditures. This is a bit of a vicious circle, because as you devalue, the weight of external debt becomes more important. You're also pushed to borrow domestically, because you cannot borrow externally, and you crowd out the private sector. It reduces growth. So it's a vicious circle that gets entrained. Now, the multilateral institution, the IMF, want to help, but how do they help? The amounts due are much larger than the financial safety net. So you would have to double disbursements just to refinance debt at a time where the MDB system is talking about scaling up to support a green transition, climate investments. So aid effectiveness right now is very low, if not zero. Basically, net transfers to this set of countries are zero. The MDBs are putting money in, is going out in debt service, mostly to the market, but also to China. We have these two waves coming down. And so they have a big dilemma. they could just refinance countries, but then they won't be able to deal with the climate. And if they want to deal with the climate, and this is the strategy we have suggested, and the American Treasury is now pushing for that as well, kind of a win-win, it seems, would be to bring together the climate transition and the debt, and to grow out of that, basically to invest heavily by the multilaterals and the World Bank, reserve that for investments, grow out of debt, but the quid pro quo would be for other donors to accept to roll over their debts. Now, what the Americans have proposed is that China at the IMF would reschedule, and the IMF would use the lending into arrear to put together programs that preserve a place for investment. As for the market, we'll have to convince them that countries are growing, will be growing in a credible way, maybe use some guarantees as well to push those rates down so that you can actually roll over at better rates. If none of this works, if interest rates don't come down in a few years, then it will be clearer. It will be a case of insolvency and potentially of a systemic crisis that would delay the green transition by a decade or more.
We'll come back to that later on. Martin, if you want to complete from a South American perspective on these issues.
Absolutely. And I may be a little bit broader than that. So regarding the consequences of the debt landscape for global financial stability and for stability within countries, as always, the key is going to be R minus G. The difference between the refinancing rate and the growth rate of outputs. And in this panel, what we heard is that it's actually unlikely to expect low R. And I agree with that. When we saw the massive creation of liquidity in the previous decade, we were in a different world. It was as if the global economy was an open economy. Because we had workers moving from the rural area in China and India to the manufacturing sector. So at the same time that we saw liquidity pumping up, we had a larger supply of manufactured goods, and that's not the world we live in now. So I would expect R to be higher than what we saw in the recent past. The other variable, G, I think we know less about it, and probably in this room, or there may be different views. Clearly, we don't have a rational expectations view on what's going to happen in the context of rapid technological changes with growth rates of output. But what's clear is that for advanced economies, the debt situation is different than for many developing economies. In the world, as was discussed also in the panel before, for most advanced economies, debt is going to be just an intergenerational issue. And for many developing countries, it's today a sustainability issue. We can discuss liquidity, solvency, but certainly there is a sustainability problem. And the depth of that problem and the duration of that problem will depend on the global environment moving forward, but also on the structure of incentives that is created to allow for a refinancing of those debts in the countries that are suffering distress. Most of those countries were not mature enough when they access international credit markets at the coupons they did. And of course, there's a multiple equilibrium notion there. If you access markets at high coupons, we know that the risk is higher and vice versa. But what we see today is a situation in which there are net positive flows coming in from international financial institutions, and at the same time we have net negative flows, meaning outflows, explained by the lack of refinancing of debts with the private sector and China. And that's very risky because countries may end up with a structure of debt in which they owe more to the creditors that are senior, which makes a further resolution of the problem higher. So there may be some element of betting along the way, but if it goes too far, the risk becomes higher and higher. And if we have this environment of higher interest rates, over time, R for developing economies is going to increase because it's true, we have most of the contracts are at fixed rates, but every time a contract matures, it has to be refinanced at a higher rate. So the average rate should be increasing over time. The irony is that today, which is different than in the 80s, we had a structure of fixed rates with the private creditors and floating rates with the IMF and to an important extent with China. So to summarize, we do face a serious risk in the future that countries that today are at a disadvantage end up being at the larger disadvantage, also to make the investments that would allow them to leave out of that trap, which is a matter that we'll discuss probably in the third question.
Thanks a lot. To add to the complexity, I think there is also a situation to complete the picture where primary surpluses are also too low to make it sustainable in the short and even long term. So thank you. We'll now move to Ernest. Ernest, so he's governor from the Central Bank of Ghana. So he will provide us with an African perspective. So Ghana is interesting in that case because it defaulted a few years ago, but went through a serious adjustment program, so that you will perhaps elaborate further on. Ernest, the floor is yours.
Okay, thank you very much, Laurent, for that. And let me thank Hamuda, who asked me to attend this conference to share the Ghanaian experience. Now, my take on this is the current high interest rate environment is because of the policies that were implemented during the pandemic. So the pandemic really is the starting point for all of this. And if you look at it that way, you take a country like Ghana. This was one of the fastest growing economies in sub-Saharan Africa before the pandemic. We were growing at 7-8%, and then out of the blue, we had this pandemic coming in, and the fiscal policy response to the pandemic was not very different from what happened in some of the advanced countries. The quantitative easing, the fiscal interventions that were put into place. But the impact of those policies was to drive the fiscal deficit to a very high level. I mean, we recorded a deficit of almost, I believe, 12 or 13, 14% in 2020. And this was really the seeds of the debt sustainability problem that the country had. But even after that level of deficit, the country still had access to the capital markets. And in 2021, we were able to borrow nearly $3 billion from the capital market. So I'm saying so because our friends at the rating agencies, the Moody's and the Fitches and all of those rating agencies, did not exactly react early to the deterioration in fiscal conditions. And then what we saw was a deterioration in the economic conditions by late November 2021. By January 2022, we had the Russian invasion of Ukraine, shooting energy prices up, food prices up. And then we had all three rating agencies downgrading the economy at the same time. What do you expect? Immediately, that triggered a very large exchange rate movements. Inflation went through the roof, and the country had to go to the IMF for support by the middle of the year. So we have been through a major debt restructuring exercise. We are no longer talking about a risk to a crisis. We've been through the crisis, and we are working our way out of the crisis. And we believe that most of that is going to be behind us soon, in the next few months. But we also do still have very high inflation, I mean, inflation got as high as 54% at the peak of the crisis. Today we are at 25. Interest rate policy still at 29%, and inflation still around 25%. We're hoping to get to around 15 by the end of this year. Now, the high interest rate environment also means that we are not attracting a lot of, capital. That's some kind of pressure on our local currency, and therefore there is also a limit on what you can do with the policy rate, locally. And these are some of the challenges that we have currently. I'll end it there.
Thank you. So you, in a way, introduced the second round of discussion, which is the interplay with monetary policy. So most speakers talk about high inflation already, and the response to that high inflation was a dramatic raise in interest rates. And now it has also affected long-term rates, which are likely, as some of you already alluded to, remain at very elevated levels. So the question is whether and how this can obviously feed back on monetary policy decisions. Perhaps to complete the picture, because you mentioned also the fact that you have two big global economies which are also under scrutiny, I would say, the US and China. And those two countries are the two major economies now in the world. So what happened to these countries is very likely to affect also global financing conditions. So meaning that for many countries, in fact, financing condition will be in a way imposed or exogenous. So imposing further pressures on their policies. So perhaps these are the kind of issues that we can touch upon. So we'll go in reverse order. So well, Ernest, please.
We just completed a monetary policy committee meeting, and the issue of the external interest rate environment, this central bank's posture of higher for longer, that sort of, in a sense, sets you up in terms of how far you can go in terms of lowering interest rates in our domestic economy. And having said that, we've also seen some very strong stickiness in the inflation rate. We're not seeing the disinflation process going down as fast as we expected. Some of it is a reflection of imported inflation. We are seeing a lot of imported commodities that are coming in at higher prices. And I think we've seen some worsening of the oil price situation also in the last 3 months. And these are all creating a constraint in terms of where we are with our policy rate. The stickiness of inflation at around 25%. We've had this since the beginning of the year, and we were looking forward to seeing inflation decisively going on the downward path so that we can also follow with the policy response. And that hasn't happened, and we are hoping that maybe the next reading of inflation might allow us to resume, the reduction in our policy rate. But I think the global interest rate environment makes it more difficult when you are on a disinflation path to be able to consistently go down on that path.
Thank you very much. So we'll move now to Martin, if you want to elaborate on that. So I mean, the point that was made also about, I think Ishac also mentioned the uncertainty of the current period. So also with respect to this inflation process, obviously it has been perhaps decreasing in terms of, but not necessarily as fast as expected. And as you mentioned, there are now also additional shocks that were not expected, in particular on commodities, for instance, which are still pushing a higher inflation and perhaps also delaying the adjustment in interest rates. So, Martin, I'll leave you the floor.
Okay, so first, there is, of course, an obvious interplay between monetary policy and that sustainability. The quantitative tightening approach followed by central banks of advanced economies and the interest rate hikes is the main driver of the global liquidity scenario and the main driver of sustainability problems in the countries that are suffering those, mainly the low income and low middle income. There is another channel through which the monetary policy of advanced economies affects borrowers in distress, which is the IMF rates, because the IMF interest rate is tied one-to-one with a special drawing rate, which is a weighted average of the yields, 3-month yields of the bonds of the 5 countries or regions that issue reserve currencies: the US, UK, China, Japan, and the European Union. So the reaction from the transmission from the rate increases in advanced economies to the cost of the debt with the IMF is immediate, or almost immediate. It may take a week. And that's an important issue for countries that are suffering from a situation of distress today. But also the increase in the monetary policy has, of course, fiscal consequences. And they have to be, the trade-offs are more delicate in a context of tighter constraints. Then I'm just going to make a comment about my country. We have special cases. In Argentina, we've seen the opposite path now. There's a reduction in the interest rates. And actually that helps. It sounds strange, but it helps to reduce inflation, mainly because the financial intermediation channel is broken. So the reduction in the cost of the central bank rates decreases the future monetary supply, and future in Argentina is 30 days. So that's it may seem counterintuitive. I would analyze the spillovers and the transmission chance from monetary policy to fiscal sustainability according to the environments that we have for each country.
Thank you. I think you raised also an interesting point, which is that the situation, I mean, what we have inherited from several years is also the fact that your own financial system may be also disrupted, and high volatility in interest rate have also perhaps raised additional challenges in some countries, actually, which needs to be taken on board. So maybe Ishac, so if you want to.
I mean, I'm not a specialist of monetary policy, but from what I'm seeing, it's much harder under high levels of debts. External debts, I mean, you know, to the extent there are devaluations, external debt is much more costly domestically. And domestic debts are very high. I'm talking, again, Africa, Middle East oil importers. And that was good ex ante, right? Domestic debt, you know, the markets increased, and a lot of the growth was financed domestically with higher domestic savings. But when things go bad, the fact that domestic debt is high makes it very hard to stabilize. You know, the governor could tell us about the case of Ghana, but say the case of Egypt is spectacular. There was lots of non-resident holding of domestic debts. The government was keen to maintain the exchange rate, fear of floating, as long as possible. The country relies a lot on remittances, and so a fixed exchange rate is supposed to attract remittances, otherwise they go to the black market. But risks increased, the black market deteriorated, and one Friday, suddenly there was 20 billion of capital flight, so the exchange rate collapsed. The bond market, the yield shot up, so literally the crisis came very fast. And then stabilization has been extremely difficult. The huge devaluation literally canceled all domestic debt, but then you had to, the central bank had to raise the rates and the real rates so much that it got rebuilt literally in a few months. and stabilization is extremely difficult. If you look at the IMF program, which just was agreed, an enlarged program a few months ago, it has primary surpluses going up to 5%, and everything in the fiscal squeeze to the tilt, with interest payments now mostly domestic, in spite of the huge devaluation, reaching 7% of GDP, total interest payment 10% of GDP. So it's very hard to stabilize. You would expect countries to be using more capital controls in these situations, but you know, again, we haven't seen that in many countries, because somehow there's so much reliance on attracting capital, on retaining non-resident domestically.
That's an interesting point, because over the past few years, there has been increasing interest in macroprudential policies, and one of them was also to look perhaps further on capital flows. So that was an instrument that was also put forward even by international institutions like the fund, which has not necessarily been put in place for the reason that you described, but that has to be also taken in the picture. So Elena, I will give you the floor. So since it's a panel, you have also to react to what the others said, and in particular, Ernest mentioned the role, also the key role of credit rating agencies in debt dynamics, but also whether they are pro-cyclical or not in a way. So it's a trick for you, but
No.
or a trap rather.
No. Happy to address. Maybe let's start with the monetary policy side, and I'll go through and I'll give you a little bit more details on what the fiscal picture looks as well across the countries. On monetary policy, we actually would agree on the interest rates. We expect, even if inflation is coming down, so we do expect it to continue to come down through the year. For most countries, we do expect the central banks to start cutting, Fed to start cutting rates in the second half of the year, and most of the G20 central banks will be cutting rates through the rest of the year and next year. So all goes well, you know, if inflation continues to fall as expected, we will get some rate cuts. But even with the rate cuts, even if all of the kind of forecast materials as expected, and we end up with after the 2 years of cutting, we expect the rates to remain higher than where they were in the 20 years kind of before the pandemic. So that will weigh on debt sustainability, will weigh on debt servicing costs for issuers. So that's on the monetary policy side. Fiscal, we sort of went through a year where fiscal and monetary policy were both tightening. I think for this year, we are looking at, again, all goes well with inflation, monetary policy loosening through the second half of the year, while fiscal policy is starting to tighten in many countries slowly. So they'll work a little bit across roads, but that's kind of the macro cycle. On the fiscal side, the picture is, maybe I'll give you a little bit what the picture looks across the portfolio, and then I'll talk about the risks after that. So, you know, 70% of sovereigns are seeing primary balances coming down. The median improvement in the primary balance is about 0.4 percentage points of GDP. The fiscal consolidation is a little bit faster in advanced economies because of the withdrawal of support measures. So the pandemic support measures, the higher energy prices support measures are coming off, and that's leading to some fiscal consolidation. In lower rated sovereigns, the fiscal deficits will remain wider, and that's both given you have smaller revenue bases there and also large development spending. There are a few pockets where debt is actually coming down more materially. So if you look at debt to GDP ratio, again, stabilizing for most of the portfolio, there are a few groups of countries where we're seeing more material improvement in the debt burdens. One group is the several European economies which took structural reforms over the last decade, so including Greece and Cyprus and Portugal. Debt levels there are coming down more materially. A group of tourism-reliant sovereigns such as the Bahamas, Barbados, Jamaica, where growth is a little bit higher, and that's bringing debt to GDP ratios down. There are a couple of oil exporters, oil producers as well, so Qatar and Oman are examples there. So this is sort of the groups of countries where debt to GDP is coming down faster. On the opposite side, there's still a number of countries where debt ratios continue to rise. So there's some emerging markets such as Mexico, Poland, Romania, Chile, debt ratios continue to rise. There are also a number of advanced economy as well. So we have Israel, Malta, you have the US, you have France, where that's moving up. On the magnitude of the sovereignty was calculating. So if you take the US, Italy, and France, the additional fiscal consolidation you need to make the debt trajectory stabilize is 1% of GDP. So you would need, on top of the current baseline, you would need additional 1% annual fiscal consolidation to make the debt ratio stabilize by the end of the decade. And that would be, that kind of a consolidation effort sustained over multiple years would be an unprecedented effort for those countries. So there's quite a bit of challenges. 1%, yeah. 1% of GDP over multiple, you need to do it for multiple years. Yeah. So it will require significant work there. And then on the interest payments to revenue, I'll put a few numbers just to illustrate the amount of kind of in terms of what the impact between where fiscal policy is going and the fact that we are looking at slightly higher interest rate even after the rate cuts will do. If I take the median for the advanced economy, we're looking at about slightly below 4% of GDP interest payments to revenue ratio, 4%. In 2010, that was 5%. So we're still below. If you look at the emerging markets, we're at about 11% in 2024 to 8% in 2010. So increasing. If I look at the frontier markets, the median is at 14%, 1/4, compared to 6% in 2010. That's a very large increase in that servicing cost there. And it's now, right, the frontier markets burden has now, debt levels have come in terms of they've come to the levels of the large emerging markets, and debt servicing costs are actually higher.
Okay, thank you. So to complete this second round of discussion, I give the floor now to Jose. Sorry I skip him, so
no,
I must apologize.
It's fine. It's fine. That way I got to hear everyone else. I mean, on the first question of monetary and fiscal, again, let me speak with a cliche. You should be coherent with both. What you can't do is pull one way on one and pull one way or the other, or push one way or the other. So if you, I think, and this is a challenge, because I think what we are hearing is that inflation has gotten to where it's sticky. You know, in my view, or I was surprised at how fast inflation fell after the pandemic. At the beginning, you know, it fell much faster than I expected. And I thought that in the emerging markets case, it would take longer to fall, but it fell pretty quickly. But now it's not, I think, and I think there's reasons for this, and I think both Martina and Elena mentioned them. I think it's very important, if we are to believe that, and I think we all agree that, interest rates may come down, but they're going to be higher. I think the anomaly was the last 10 years. This is the anomaly. And if we think, and this I'm almost positive, if you can be positive about anything, is that we're not going to go back to where we were. That's just not going to happen. So if interest rates are going to be higher, and somebody mentioned, in advanced economies, the inflation is falling faster. and the fiscal is contracting faster. And I think that's the key. I think like it always happens in emerging markets, we not only increased our deficits to take care of the pandemic, we increased our deficits because we don't have good institutions to contain our deficits. So now when we're trying to cut them, well, surprise, surprise, we cut the pandemic expenditure, but we sneaked some expenditure in there that was not pandemic related. So we're having a hard time. If you compound that with the fact that the interest rates are higher, well, then you have a problem. And if you compound that with the fact that typically, again, the determinants of our inflation are different because our labor market laws are more rigid. So, inflation is harder to bring down in at least a group of emerging markets when you compare to advanced economies. This makes it hard. This makes the adjustment a lot harder for emerging markets because for institutional reasons, right or wrong, inflation is going to be stickier, fiscal is going to be stickier. So, there's work to be done, I think. And it's hard because, and I agree with Ishac, it's going to be difficult to do this because we're going to be faced with having to do what we don't want to do, which is adjust our fiscal policies. That's hard everywhere. But if we don't do it, we can't expect the IMF or the World Bank or anybody to pull us through for the next 5 years. That's always ends up in disaster. So I think, that's why it's hard. And this makes it, doubly hard on the economy because you have to keep the interest rates high for all the reasons that were said. So on top of the fiscal contraction, you're having an investment contraction. Well, nobody likes that. But I think, who knows? It's a difficult process for emerging markets moving forward, I think. But, what one should never do, I think, is, to keep the fiscal loose and to tighten monetary policy. That has proven to be the wrong thing to do. So I think, you asked for what to do. How does monetary policy play? Well, it has to be coherent with what you're doing.
So thank you very much. So now we're moving to the last round of discussions before opening the floor to the audience. So the last round of discussion will focus on the perspective. So as we have seen so far, it's, I would say, rather gloomy, challenging. And so perhaps to add to the challenges and in order to frame the discussion, I would like the panelists also to give us their insights on their own perspective in a situation where most countries are typically facing a policy trilemma, which is first, as we already said, the need to contain debt and deficit to ensure fiscal sustainability, but also financial and price stability. So that's the first objective. The second is, and I think you alluded to that, so there are a lot of spending pressures with respect to more structural issues, which are related to developments, the transition to a low carbon economy that you put forward, but also healthcare in a context of global aging. Perhaps not all the countries, but most countries facing that. And also the fact that we are also in a world where I think it was also alluded initially, the geopolitical dimension is also taking another dimension that was not present before, and the need also to spend more on industrial policies to, where reduce dependencies, or at least change a bit the value chain, and also to spend a little bit more on defense. So these are the kind of pressing pressure on spending, while at the same time you need also to adopt measures which are acceptable by the population, meaning that there is also an issue of political resistance to stagnation. So well, I open the floor, so I'll start again with Elena, then I'll move to José and Isaac, Martin, and Ernest. So Elena?
I'll take it a little bit bigger picture. There are numbers, so in addition to the fiscal adjustments that are coming to this year, there are a number of structural shifts that countries and economies will need to deal with. And some of them are longer term themes, but they are here now. And we are seeing them starting to affect credit now. I'll start with the risks, and I will go to the to leave it a little bit of a brighter. I think it's a mix of risks and opportunities. It's not just risks. But I'll start on the risk side. So obviously the higher for longer we talked about. There are still risks to inflation. There are still risks to food and energy prices. Geopolitics is the other one. So mostly on the risk side, but it will have implications for trade. It will have implications for supply chains. It will have direct fiscal implications for defense budgets. It will also have implications for energy and commodity prices. And that channel is quite important. What we saw on the back of the Russia-Ukraine conflict, actually the shock that came, and it was not just Ghana, it was for many, many countries, many companies as well. The shock that came on the back of the increase in commodity and food prices, food and energy prices, on the back of the spillovers from the Russia-Ukraine war came much stronger, and they had much more severe credit effects than actually the pandemic shock. So, those could be quite damaging to the global economy in general. So those two on the risk side. Aging and demographics, again, it will have, most countries are dealing, apart from a few countries in Africa, most countries are dealing with this now. And it's impacting labor supply, it's impacting entitlement spending, it's impacting the provision of healthcare. Usually on the entitlement spending side, right, the US is a prime example where most of the government spending, it's actually non-discretionary spending, which is social security and entitlement spending. And that to sort of change the fiscal trajectory, you need to reform entitlement spending, and that's politically difficult issue. Climate risks, we've talked a lot in this conference. They're front and center. I think we are starting to see the impact of physical climate risks very directly. You have the severity increase in damages. You have the hurricanes in the US, you have the heat waves in India, you have the droughts in Africa, very directly. Governments are not ready, local governments are not ready. The infrastructure is not of where it needs to be to deal with the severity of those events. So that will require adaptation too. And again, that will also, the investment in grid, so the physical climate risk is mostly we need to manage, so it's on the negative side. But you have opportunities there as well, right? So the green investors, you're building new sectors, you're creating new economic opportunities. Countries that are producers of the minerals of the future should be able to benefit from the green investment as well. And then the last one is new technologies. Very fast changes on the technology front in terms of digital finance, in terms of artificial intelligence in general, generative artificial intelligence right now. Again, a mix of costs and opportunities. For now, I think we're starting to see the initial impacts at the company level, and we'll see them at the sovereign level, I think a little bit down the road. But for now, the investment in the technology comes first. So companies are experiencing basically large increase in expenditure in order to fund the technology and the implementation of the technology. Hopefully a few years down the road, we will see some pickup in productivity on the back of that as well. I think for now, again, I think we're seeing most directly on the company level, our corporate teams are expecting to start seeing sort of credit positive impacts from 2026 onwards. So it is a couple of years down the road, but we should see efficiencies on the back of that as well. So it's a number of sort of structural shifts that are hitting the global economy and in all of the countries at the same, and not each one of them is a challenge to tackle. They're sort of hitting at the same time.
Thank you. Jose, you want to elaborate further on these issues?
Yeah, well, I mean, to me, the surprising thing is that when the pandemic hit and most countries expanded their fiscal deficits, people started talking about what this would look like the day after. The surprising thing is that the day after was like a week after. And there's a reason for that, I think. And once again, in the discussion, it's been a bit lost. Things could be a lot worse if the predictions that there was going to be a recession in the advanced economies would have materialized. Because then we would have high interest rates and low growth. And this goes back to what Martin said. So today, the advanced economies, even though inflation is sticky and interest rates may be higher, you have all of these new developments. We're on the verge. We can argue all day whether artificial intelligence is as big a thing as it's meant out to be, but it's not small. I mean, no matter how you measure it, some people compare it to electricity, some people compare it to the internet, some people compare it to the cell phone. It's not small. You can pick where you want, but it's not small. So if that's true, then there is, as Elena said, a bright side to this. So emerging markets are going to face higher interest rates, but they're going to also to face higher demand for their products because advanced economies will continue to grow because the productivity continues to move forward. Which effect will dominate? I think that depends on how fast each country adjusts. If you manage to adjust your fiscal and keep your monetary coherent, you'll be okay. If you don't, well, then you're going to have a problem. But let me finish this round in my turn, because as I heard a lot of discussions in the conference, somebody said yesterday, I want to be provocative. Well, this may be controversial, but this is a reaction to something I have heard. If there is another round of restructurings coming, let me again, as I told you, I spoke in cliches and analogies. Making restructurings easy is like, it doesn't seem to make sense to me because if restructurings were easy, then investors are going to demand a higher payment because, I'm going to issue a bond that's easily restructured. Well, then I want a premium on that. I mean, that's why countries, as they increase their credit ratings, they like to tie their hands. They go for fiscal rules. They like to say, no, I'm never, ever, ever going to restructure again. So as in this conference, we think about restructuring, it's a bit like the labor market. If you have firing restrictions in the jobs, you're going to have hiring restrictions. Same here. If you make it very easy to restructure these bonds, then you're going to make it very expensive for countries to issue them. So as this progresses, we need to strike a balance. I mean, and it's completely time inconsistent, but restructurings are a repeated game, even though the way to make them is, this is the very last time Mexico is going to restructure. And this is the very, very, very last time, I promise, until the next time, right? So in the process, my reflection for, everybody who's thinking about these issues is, one must be careful to do these things, because if you make it too easy, you're going, you may restructure in a long time, but you're going to have to go to the markets tomorrow. And if your bonds are easy to restructure, you're going to have to pay. You choose. You can't have it both ways. That's why, advanced economies seldom restructure. And having an analogies, and this is also a cliche, to companies is not a great idea either. Countries don't go broke. countries don't disappear. You know, companies disappear. You can liquidate companies. You can buy out a company. You can't buy out a country. So you can't think of it the same way. So that's my latest reflection. But, you know, even though I think the panel has been gloomy because the interest rates are going to be high, we have to also emphasize that the economies, the advanced economies look good. There's not a massive imbalance in any of the advanced economies anytime in the near future. People are not talking about an important recession. You know, even the biggest skeptical of a soft landing public is skeptical of a soft landing. Larry Summers now says it's a real possibility. So that has to be good news. So, you know, we have two forces here. But in the process of solving these forces, that's why I wanted to put my little grain of salt that everybody may disagree with me, but never mind. I wanted to say it to get it off my chest.
So I think the message has been heard, but it may come back during the Q&A. Isaac?
Yeah, I mean, building on San Antonio and what you said, I don't know. I think I leave this conversation more worried than initially. I was still under the impression that you know, the outlook is more favorable. Rates were falling quicker. You know, at the same time, I'm not completely pessimistic because, as you said, there are many growth opportunities and Jose Antonio as well. Again, focusing on the low and lower middle income countries, which are the countries we focus on at FDL, the long-term growth prospects is there. I mean, 4 or 5% real term, you know, catching up on technology, investing in the climate transition. There are many sources of growth over time, and you know, the real interest rates, even as you said, they may go up. Not 0, 1, 2 real. 2 real is still less than 4 or 5 real growth. So the R minus G doesn't look bad in the long term. But you know, the long term, we live in the short term, and the short term, the house is burning. And so these countries, it's the first time they go to the market, and they have to pass this cycle. And it's very hard to pass this cycle without the house burning because it's a long cycle. You know, they've deteriorated their credit rating. The time the interest rate come down and their credit rating improve is going to take 4 or 5 years, perhaps 4 or 5 years without being able to refinance. Maturities coming due is literally impossible to survive. And so this is an emergency to do something for public policy. The international safety net is not large enough for this particular situation. There are great plans for the medium long term. We'll never get there. And so, you know, this is a wake up call. We need more SDRs in the system. We need to put pressure on the market to reschedule. Now, you know, next cycle around, it doesn't have to be like that. You know, as Pepe Antonio said, bonds will adjust. I mean, we're talking already of clauses, of, you know, already in restructuring agreement, there is VRI, contingent clauses. So we're moving to a new phase of things, but we don't want to get stuck now. And the global community needs to do something to prevent a disaster. Now we see a slow disaster going into the wall. And unless something happens, we will get into the wall at some point.
Okay, thank you. Martin?
Good. So basically your trilemma had 3 parts. The need to contain debt or debt sustainability, then the spending pressures, and finally the political resistance to taxation. I'm going to refer mostly to South America, the trilemma in South America. So we have an environment in South America of low G. The continent has been stagnated for about a decade. And R is higher today, and it's actually increasing. So R minus G is higher. Debt to GDP is also higher in the continent. We couldn't use the slides today, but otherwise I would have shown that the 2008 crisis in the US was very significant for the evolution of the financial situation in the continent. What happened afterwards is that debt increased, and particularly debt in the form of bonds, okay, in the context of more liquidity. So if we have higher D, higher R minus G, how do we deal with that? Well, there are basically three ways. We either consolidate the public finances, meaning that we need higher primary fiscal balances, or we resort to more debt, but that has consequences for the dynamics of the debt. And of course, it's not just up to the borrower, but it's also up to the creditors. Or we end up, if the institutions and the political situation allow it, having more inflation tax. There is no way around that. So that's what happens. So this current debt landscape does create more intense trade-offs alongside this trilemma. And ultimately what happens is that governments have very significant troubles dealing with those. The fiscal consolidation is politically costly. And not only there are troubles for doing the consolidation of spending, but also within public spending, the priorities are distorted by the politics. And a big problem is what I would call corruption American style, which is new in the region, but it exists, such that what should be illegal becomes legal, and it's better for a government to not to reduce certain item of spending that should not be a priority, because that can be used for political purposes, including managing resources that can be used for politics. So ultimately what we end up having is this social discontent and political fragmentation. We are in an era of coalitions. Many of the governments in the region are coalitions. A colleague from Columbia University, Mauricio Cardenas, has a recent study that shows how unpopular presidents rapidly become in this context. And on top of that, we have the problem of taxation. And the main and most effective resistance to taxation come from the rich and from the multinationals, mainly through the use of tax havens. So that also puts a larger burden on the small and medium enterprises, on the non-rich people who complain about the state, and that delegitimizes the state. So tackling the problem of progressive taxation is a major issue. It's an international problem, not just a domestic problem for the economies. What all this picture shows is that there is a threat to the legitimacy of democracies. But ultimately, there is a very important role both for governments and for the design of institutions. The political situation can also change. Argentina is an example in that sense. I was taught as an undergrad that the budget constraint of the government tells you that your primary balance is equal to the growth in debt or the variation in debt plus the inflation tax. If you have deficits and no access to financing, you end up having more inflation. And at some point, the society may just not tolerate that anymore. So even if it becomes at some point very difficult to do a fiscal consolidation, the society may just reject and the political situation can change. But the institutions may be a key determinant of the political situation. And in this sense, institutions that prevent countries or incentivize governments to have a more prudent stance on debt, and also more difficulties to abuse of central bank financing, I think will play in the current context clearly a positive role. Just one last minor comment, given that we can engage into discussion later and related to Jose's point on the restructurings. I wonder, Jose, if you would say, rather than making restructuring easy is not the way, whether you would say allowing for more opportunistic restructurings would be harmful, not easier, right? Because we could have easier restructurings, but with the purpose of restoring debt sustainability, and that shouldn't be bad. That should help countries to avoid efficiency losses that are worse for the creditors and the debtors. One example in that sense is the adoption of the enhanced collective action clauses in 2014 that improve the capacity of debtors and creditors to finalize a restructuring, and they didn't lead to an increase in yields.
Jose, you want to complete before I give the floor to Governor Addison? No? So Governor Addison, please.
Well, I wish I wasn't the last person to speak this session to avoid the gloom, but unfortunately,
we are coming back to gloom.
Coming back to gloom. The issue of the policy trilemma. I mean, this is what IMF programs tend to do, to get the fiscal sustainability and price stability and financial stability. And we have had a very strong IMF program to work with, looking at primary balance, working our way up to a primary surplus of 4% of GDP over a 4-year period. And this is coming from a primary deficit of about an equivalent amount. So that's a lot of adjustment in a very short time. You're looking at what it means for the tax authorities and revenue mobilization. You also have to look at, what that means for those of us on the financial stability side, trying to keep the financial system stable. So the macroeconomic adjustments would have to take place. But in addition to the macro adjustments, we had to restructure debt. And really, this is the very bitter part of all of this. And I agree. I'm not sure whether I would support my friend's view on making restructuring easier, because restructuring is a terrible thing to go through, and especially, for those of us who have had to restructure domestic debt as well as external debt. This is the worst of both worlds. And domestically, you have to deal with the various parties that are holding government instruments. You're looking at pension funds, very poor people, very vulnerable people who have lost their long-term life savings, and the political tensions that creates. Households also who lose money in the process. And then the domestic financial system, which was very heavily exposed to government debt, and the huge losses that were imposed on these financial institutions, and more or less resetting the whole financial system up for recovery, in a sense. And then you come to the external debt part of it, which is also very complicated. So I think that the issue of debt restructuring should be avoided, if possible, and possibly trying to streamline, how these restructurings are done. I know in some countries the domestic debt were not restructured at all. In the case of Ghana, we couldn't avoid a domestic debt restructuring because it was quite large relative to GDP. You're looking at a total debt of about 120% of GDP. And the decision was taken to bring this down to 55% in 5 years. That's halving the debt, over a period of 5 years. So it required a lot of effort. The central bank was also largely exposed in this restructuring effort, taking nearly a 50% haircut on our exposure to the government. We are having to operate with a negative equity in our balance sheet. And it raised questions about independence of the central bank and its ability to deliver on its mandate. And we actually had a demonstration against the central bank for allowing itself to be restructured in that manner. So it's a very complicated matter. It's an experience that I wouldn't want to wish on anybody. And if there are better options to what we've gone through, which is the G20 framework, I don't think I want to recommend that to any country.
So that's positive in a way. So I think that unless some of you want to react to what has been said, we can open the floor for questions. So if you want to raise a question, so please present yourself, and then you can use the mic which is in your armchair to raise your question. So I'll leave it to you. Yes, in the first row. So you have to press on the button.
Hello, Carlos Winograd, Paris School of Economics. Well, first, thanks, because it was very stimulating and calls for a lot of questions, but obviously there is a lot of people. But with a certain pleasure for the thought-provocative interventions, I will go a bit building on Jose's feelings on the stability, on the worst case scenario, for two reasons. One is that it's always better if you are a bit risk averse, and we could think that medium voters tend to be risk averse, to follow the caution principles, the principle of prudence, and get ready for the worst scenario, even if probabilities are 1/2 for the other. The comparison between the 90s and today, to deepen the provocation, have a few differences, I would say. And one is the levels of debt. The average levels of debt of the developed world are much higher. Actually, they're probably the highest in 5 episodes in the last 150 years of debt, and certainly the highest since 1945, going out of World War II. And that shifts the degrees of fragility of mistakes. So error of type 1, to think that the good scenario and to miss the good scenario, or error of type 2, to miss the bad scenario. I prefer to work on the second one because it's more risky. On the levels of debt are higher, which means that the mistake has a higher probability to lead to derail in the developed economies. Maybe saving the case of Germany, that is higher, but still in levels that are not massively distorted. But on the other hand, if we look at the political economy of the developed economies, we see 3 things that we didn't have in the 90s. One is the deepening of the democratic transition and the tensions on all the pension systems, and the demographic bonus is not there. We have a problem, a serious problem there from public finance. We may have opportunities for growth, but we may have concomitant financial disorder. This is not, it doesn't mean that if G is high, you cannot have imbalances in public and monetary finance. The second one is, just now, we can expect a demand for rearmament in the EU that will push budget demand for rebuilding the arm industry, but also the equipment of the countries in Western Europe, that again is a demand for funds. And third, the energy transition. We discuss a lot about the dynamics and the possibilities of energy transition, but we only see demand for funds. So this, we didn't have it in the 90s. And I also agree that there is another thing that will be a tension in policy making, that is, whatever we think, we may get to 3% eventually. It seems that the target of 2% will be super hard. And then it poses a question. Will we change the targets at the levels, but then in the future, well, I will advance my opinion. We shouldn't. We should go the hard road, because a future shock that will lead from 3 to 4 will put up the same question, and we know how we enter inflation, and you know how difficult it's to exit. Thank you.
You want to react?
Sure.
Other panelists also, you feel free to give your views.
I mean,
also.
I think, to react to Martin's question, I think this is more complex, and I try to say, I oversimplified it, but, if a country can't pay, then the optimal strategy is to restructure. But this is a time problem, and it's a time inconsistent problem. So if you can't pay, then you have to restructure. But when I'm lending to you, how do I know whether you're going to be able to pay or not? It's a different time. So that's what I meant. And when you're asking for money, and this is true at all levels, even at a country level, the promise is that you're going to pay. You tie your hands to say, look, I promise on the souls of my children that I am going to pay all of these bonds. And if you don't tie your hands and put that on paper, then they're going to charge. So that's why the discussion is hard, because once you're stuck, sure, you want to fix it, but you want to fix it for the very last time. So that's why I think, I'm sorry I was confusing. I didn't mean to say restructuring, we should make restructurings easy. I meant exactly the opposite. Be careful when making restructurings easy, because we may push all of the countries out of the markets, the emerging market countries out of the markets. That's what I wanted to say. If a country needs it, sure. But then what happens the day after when they have to borrow again? Are they going to behave, or are they going to come back in 5 years? If they're going to come back in 5 years, then, the markets start learning and the rating agencies start learning, and they say, look, they just restructured 5 years, so we want to wait. We want to wait. So, even though it sounds like we're trying to do a good thing, that's all I wanted. That's what I meant. And, from the question, everything you said is right. I pose a question back to you. Does that make the situation better or worse? Well, yeah, exactly. So and he said we were gloomy, so I didn't want to sound too gloomy in the panel, and I agree with you. I think there's in the case of the United States, there's a public mandate, and it says 2. In the case of my country, there's a public mandate. It says 3. Now we can move the goalposts. That's easy enough to do. But I absolutely agree with you. That's not the solution. I think, and I will go back to Ishac. If the house is burning, we need to fix it. But we need to throw the right stuff on it to fix it somewhat permanently. And I think my view is, and I agree with you, nobody wants to go through a restructure. That's just a nightmare. But to avoid that, you have to have long nights, which means you have to consolidate your fiscal. You have to keep doing structural reforms so that you keep on growing. There is no other. There is no way. I mean, the last time Mexico restructured was in 1990. And we used to crack a joke, and I'm going to say there was 2 ways for Mexico to pay its debt. An unrealistic way and a realistic way. So they said, well, tell me the realistic way. And the realistic way was for and for us is La Virgen de Guadalupe, for the Virgin Mary to come down and sign a check for $100 billion. And I said, well, if that's the realistic way, what's the unrealistic way? Well, for us to consolidate the fiscal deficit, to do the structural reforms, and to get everybody back to work. That's the unrealistic way. It turned out that we renegotiated, we restructured our debt. It was very painful, the Brady plan. But what really got us out was NAFTA. Then we grew out of it. We grew out of our problem because of NAFTA. So, now it's not easy to find your NAFTA.
So Martin, then Ishac, and you want also to, no? You're fine. So Martin? You're fine. So
yeah, just to make it a bit more exciting, I want to disagree with something Pepe Antonio said, which is it's always bad to make restructuring easier. I don't think it's true, because especially for low and low middle-income countries, that when they're hit by negative shocks, it's good to restructure quickly. You know, it avoids transition costs, make the cake smaller for everyone, including for the creditors. You're right on moral hazard. You don't want to create moral hazard. You want them to tie their hands on behavior, but they can't control external conditions. The markets don't know how to, in the past, didn't know how to value contingent liabilities. And so the only adjustment mechanism is restructuring. And so in a way, you want to make it restructuring easier for external shocks, but still costly for moral hazards, I'd say.
Thank you. I think we have time for another question. So maybe there, just to move and to check the mics. So please introduce yourself. Yeah. Try the other one. You want to take it, Elena?
One thought that is from the, this is sort of the standard economics textbook prescription, right? So the thinking behind this is a short-term thing. So you raise interest rates, inflation comes down pretty quickly, and you lower it down pretty quickly. So that shock from the interest rate is short temporary. So I think that's where the economic prescription comes.
Governor Addison?
Similar to what my colleague just said, I mean, we have the same experience in Ghana. We had to tighten monetary policy rates up very quickly, and we've seen the response on the inflation side. Inflation has come down, but as I said, we have seen some stickiness in the rate of inflation, and therefore we have kept the policy rate, as I said, at 29%. But yes, the fiscal authorities are concerned on the high interest payments and how that affects their budget, right? And you see that the market for government instruments at the auction has been forced to go down faster than where the policy rate is. Current 91-day treasury bills and 182-day instruments are around 25%. So you almost have a 400 basis gap between where the policy rate is and where the government wants to borrow at, right? This is the kind of tension that we have because of the very issues that you have raised. I think that, and this is happening because of the delay in inflation correcting very quickly. So if inflation corrects very quickly, maybe you see the policy rate go down quickly to meet where the auction markets are. And if we keep inflation sticky at where it is, then of course the auction rates will have to come up to, to meet the policy rate. That's the kind of tension that we are currently going through.
So Martin, and this would be the last words of the panel.
Okay, so very quickly on the question.
Make it good.
Okay. No, so very quickly on the question, besides what was said, if the country doesn't have a credit market, the cost in the interest rate could actually lead to more inflation rather than lower inflation when it increases the fiscal deficit. But just to conclude the discussion on debt restructurings, which I think is a very important one. So if we were in the world described by the theorems that every student of economics learns in micro Arrow-Debreu theorem, in which markets are complete, we will never need a restructuring. There will never be a sustainability problem. All the contracts would be fully indexed to all the possible contingencies in the economy, and we will know all the possible contingencies in the economy, so the contracts will be complete. But that's not the world we live in. That's not the world of sovereign debt. That's also why for emerging economies, there is a risk premium in the coupon, which assumes that there will be some probability in which the debtor will not be able to make the stipulated transfer in the contract to the creditors. Otherwise, the risk premium wouldn't make sense. And there are situations in which the restructuring economy doesn't find an equilibrium, it doesn't find a fixed point. You want to consolidate more, but that also has a consequence for economic activity and therefore for tax revenues, and you never get to the point of sustainability. At times, the sustainability is not just a purely economic issue, it's also a political issue, because many emerging markets, or most emerging markets, not anymore most, but many, issue debt in foreign currency. What's needed to create the foreign revenue to repay the debt is a contraction in imports if exports don't react quickly. And the society may just not tolerate that under certain circumstances, but it can under others. But ultimately, I just wanted to emphasize that in a world of incomplete contracts, we should actually expect restructurings. It's part of the environment.
Okay, so I would like to thank all the panelists for these very fruitful discussions. Well, I'm not sure whether we conclude positively or negatively, but at least it raised the issues of time consistency, consistency across policies, the need also for strong institutions. Some of you mentioned also the risk on political stability in a way. So I think these are very interesting topics. So now we'll have to break for, I don't know how many 5 minutes. The time for
a bit later we'll have a 15-minute break.
15-minute break. So
back for the second panel at
the second panel will start when Odile Renaud-Basso will join. Yeah.
At 4:40, 4:45.
Okay, thank you.